Good morning, Rare ECN listeners. This is your Forex market commentary brought to you by Rare ECN. Wrapping up this week's discussion, we will examine the euro-dollar pair in this commentary. We will first discuss market sentiment on a single currency and why yesterday's recent sell-off can be linked to the emergence of risk-off theme. Those of our listeners who are trading the euro-dollar pair, I hope this commentary can prove to be insightful for you in formulating a winning trading strategy. First, in line with this discussion, we will examine the euro-dollar pair on the technical front. Here we have the euro-dollar hourly chart interval. With reference to the SSI, which is also known as the Speculative Sentiment Index, this week trading sessions show us that the total retail traders have been sitting on their most short euro positions on record, as speculative traders see any rally as an opportunity for profit taking or attempting to predict a top. When the euro broke out from the 1.3900 level and attempting to test the upper 1.3970 zone, at this point there were approximately 8 euro short positions outstanding for every 1 euro long position taken by retail traders. Currently, extreme sentiment has eased back to 6 short euro positions. This extreme selling interest by the crowd had some analysts favoring a contrarian view, which is taking on position opposing to the crowd, and this viewpoint remain attractive under the condition that the euro do not break down below the 1.3830. Analysis of a collection of technical indicators on the hourly time interval on the euro-dollar market suggests a temporary bearish market sentiment and recommend short positions on the euro. The hourly chart showed that the single currency opened today's steady trading session, inching closer to its established short-term Fibonacci support at 1.3860, while the Fibonacci resistance level is set at 1.3886. The euro-dollar pair broke out from its tight Bollinger congestion to the upside on Wednesday trading session, allowing the single currency to rally to a 2-year high at 1.3875 before the release of the ECB minutes dampened sentiment. Mario Draghi's verbal intervention on the forex market caused the euro to sell off more than 50 pips during yesterday's trading session. Draghi's remark drew connection between the rise in the euro at this level with the Eurozone inflation, by which it is the one component of the ECB forward guidance mandate. Reinforcing that selling pressure is the upbeat US core retail data, which beat market estimates. Despite yesterday's sell-off, the euro resilience has allowed it to open today's steady trading session above the 200-day simple moving average. This trend holds great significance as the 200-day simple moving average contains more or less of 1 year's worth of trading data, and it forecasts long-term market sentiment. And currently, the pairs are trading above that 200-day simple moving average, which is indicative of a bullish market sentiment on the pair moving forward. However, this bullish view is not validated on the short-term moving average front, as the euro-dollar pair opened today's Sydney trading session above the 5 but below the 10, 20, and 30 simple moving average. Therefore, collectively, this is indicative of a sell recommendation on the technical front. The Bollinger Band map over today's trading trend is very indicative of high volatility condition, as the territory between the upper and the lower band is considered as significantly wide. So let's closely have a look at the RSI. RSI is a momentum oscillator. As you can see here, the bullish bias lost traction as the trend is trapped in a trading range after the sell-off. Moving down, we have the CCI, which is the commodity channel index. It flashed between sell and buy signal. A dip below 0 to minus 100 is indicative of a sell. Now it has a price value of minus 70.9650. It shows that sell signal on the euro is still pending. Having a look at another data which reinforced the idea of risk-off trade is emerging market MSCI index. Here we have a 1-week chart of emerging market MSCI. Since the weekend disappointing Chinese trade number released over the weekend, we saw the gradual decline, and the final blow was taken during yesterday's trading session, when the Chinese released their retail trade data and industrial production, which was below expectation, and we see that major drop. So the pending fear is that this escalating problem in China could spark contagion throughout the emerging market as a whole. Moving down, we have the S&P 500 over a course of 1 week, and S&P 500 is highly correlated to the euro-dollar pair. Both are very sensitive to risk aversion. Thursday euro sell-off is mirrored by the S&P 500 sell-off on rising tension between the Ukraine and the Russians. S&P 500 act as a great thermometer to how much conviction does this risk aversion have, and how much does follow-through that the sell-off have on the euro-dollar market. Now it's time to closely examine the fundamental fronts on the euro-dollar pair. Yesterday's euro selling off could be largely attributed to two fundamental fronts. One, a disappointing Chinese leading economic indicators raises concern that a slowdown in the world's second largest economy can spark concern over emerging markets, as well as the re-emergence of the tension between the Ukrainians and the Russians. Since the euro-dollar pair is highly sensitive to risk aversion, these escalating problems have investors took some profit taking and shying away from risk trade for the remaining trading days of this week. Newsfeed indicates that the Russian is currently engaging in military exercise in Crimea. This negative newsfeed advances the demand for safe haven greenback. Another concern that investors are paying close attention to is yesterday's release of Chinese leading indicators all miss market expectation. First, in line is Chinese fixed asset investment year-on-year show a reading of 17.9%, missing expectation of a 19.4%, while the Chinese industrial production year-on-year also missed expectation, ticking at 8.6% below consensus of a 9.5%. Lastly, retail sale year-on-year come in at 11.8% below forecast of a 13.5% reading. Overnight, both the yield curve on the US Treasury and the German Bund have fallen. This is very suggestive of the early stage of risk aversion, as fear has been the underlying tone for the remaining of this week. The support for an argument for a stronger dollar is slowly gaining traction from last week's upbeat US non-farm payroll to a drop in continuing jobless claim, as well as core retail sale month-on-month, which rose 0.3%, beating forecasts of 0.2%. Friday will hold the remaining market-moving report release, and that is the Michigan Consumer Sentiment, which is forecast at 82.0. Collectively, these data reinforce the viewpoint that the Fed will be more likely to stay on the path of tapering as economic conditions improve. There has been numerous times that the FOMC members reiterate to the market that if economic climate continues to deteriorate significantly, this will alter the course of tapering. The rebound in U.S. core sale number has given investors room to revise the optimism on the U.S. economy, and the prior 2 months of weather-related economic contraction may be something of the past now. The next FOMC meeting will be held next week in Washington, D.C. Eurodollar trader are expecting the continuity of tapering to remain largely intact. Personal income for January rose 0.3%, beating expectation of a 0.2% reading, while average hourly earning year-on-year for the month of February also rose 2.2%, beating forecasts of a 2.0% reading. Collectively, they reinforce the argument that the labor market improved, household spending will eventually follow, and ultimately this will translate to a positive economic growth and inflation reading moving forward. Thank you everybody for listening, and have a great weekend.